Hi everyone, and welcome to Nuggets, the official Troy Gold podcast. With Nuggets, we aim to arm you, the physical gold owner, with the financial wisdom to understand not only the ins and outs of gold investing, but also to provide you with enough insight to navigate the current economic environment. This podcast is an audio extension of our popular gold commentary, also dubbed Nuggets, sent via email to subscribers twice a week. You can also subscribe to this email Nuggets on our website at www.troygold.app or by becoming a Troy Gold user in downloading the Troy Gold app on the Apple app or Google Play stores. I'm Dane Fillion, the co-founder of Troy Gold, and this is episode 3, and it's called Central Bankers Are Painted into a Corner. This episode is recorded on Sunday, the 21st of March, 2021. Let's get to it. This week has been a continuation in global markets and gold of the tussle with inflation and inflation expectations, brought about by the trillions of dollars, euros, and pounds in central bank money printing response since the COVID hysteria started. Effectively, this has been summarized as the reinflation trade. So what's been happening is we've seen bond yields or government bond yields, specifically the US Treasury bond yields, rising quite substantially to pre-COVID levels. And this has been happening primarily because bondholders are expecting a wave of inflation. They're expecting that because vaccines are being pushed into the system and because governments have printed so much money, that once economic activity starts normalizing and people start going about their daily lives, as it were, that there will be a flood of inflation with all this new money spinning in circulation. As a result, they want to be compensated by earning a higher yield on these bonds, and they also are predicting that the Fed will be forced to hike rates due to inflation running hot in order to almost cool down the economy. The corollary to this is if the Fed and central banks will almost keep interest rates suppressed by printing more and more and more money, and therefore just unleashing an even larger tidal wave of inflation. And the markets are wondering if they can stop that at all. So gold, being history's greatest hedge against inflation, because it cannot be printed, actually rose about $17 or 1% the past week, jumping from about $1,726 an ounce or $1,726 an ounce on Monday, and closing at around $1,745 an ounce, with quite low volatility this week. We did actually see, however, which was strange, a nominal US 10-year bond yield jumping 5% from about 1.63% to 1.72%. So the 1.72% is the highest since January 2020, so pre-COVID levels. Now, usually when nominal bond yields rise, gold does badly because there's an opportunity cost of holding gold. You could be earning some yield on if you were owning dollars or dollar-denominated bonds by the government. I think the question is why this has happened and why have we seen this strength in gold? And now previously we have talked about real yields where you take into account inflation with the nominal yield. So nominal minus inflation is the real yield. And for that we actually look at the US 10-year tips, for example, and it stayed pretty much the same, or it's still negative. We have negative real yields in the US. At the start of March, it was about negative 0.7. It's about negative 0.6 still this week. So therefore, we also have to look at what else has happened or what's been announced this week. And what we have seen has been statements from the ECB and the US Fed, so the central banks of Europe and the US, which make up most of the world economy. And both of them seem to be painted into a corner. Now, why do I say that? I think the European Central Bank, run by Christine Lagarde, have come out about a week ago and have effectively shifted their money printer into high gear. They are offering substantial increases in money expansion measures to, as they say, fight the economic effects of the pandemic. Effectively, they're signaling that they're going to keep the lid on interest rates. They're going to manage the yield curve and they're going to keep interest rates down. Now, this is a signal to the markets that they're willing to print as much money as possible to keep the cost of money near zero, and they're already negative on real rates. So that is extremely loose monetary policy. So more and more and more euros being pumped into the system. And on Wednesday this week, it was the Fed's turn to expel any hawkish rumors. In a FOMC policy statement presser led by Fed Chairman Jerome Powell on Wednesday, the US Central Bank committed to keeping interest rates near zero as well through 2023 up to 2024. The target range of the benchmark federal funds rate was kept at 0 to 0.25%, where it's been since effectively last March, or when the COVID crisis was announced. So we know that the central banks are just keeping their foot on the pedal of the money printer, and they believe they're offering support to the real economy. But when we look at the real economies in Europe and the US, it's still showing lackluster growth, very slow improvements in unemployment numbers, and the increased expectation amongst investors of an inflation onslaught by the rise in yields, which effectively leaves the central banks in a position where stimulus measures are becoming the norm. With both the Fed and the ECB maintaining monthly bond purchases and keeping their interest rates artificially low against the market's move, these once extraordinary measures are now becoming just a normal feature of the system. So where do we go from here? Well, usually we ask the masters. And this week, Stanley Druckenmiller, who's a very famous investor who managed the Quantum Fund with Jim Rogers and George Soros, mentioned that his overriding theme for investing is inflation relative to what the policymakers think. Now that means that the ECB and the Fed have come out and said they're not worried about inflation, even though they're pumping trillions of dollars and euros into the system. Druckenmiller thinks otherwise. He thinks that they have to say this, that they don't have a choice, because that is the only way that their governments can stay solvent, by borrowing free money at near zero cost of capital. So Druckenmiller, the smart money, is saying, I'll take the bet that you guys are wrong, central bankers, that you are painted into a corner, and this is your last desperate attempt to keep the system afloat and to act like prices will not move higher, but rather changing your mandate to focusing on employment and full employment rather than inflation. Both Druckenmiller and a bond king called Bill Gross, who was the co-founder of PIMCO, stressed that we would likely see inflation run in the US to 3-4% and start accelerating. Druckenmiller has said that the policymakers' response can be different depending on vaccines and how that progresses, but that he's a very short dollar position. So effectively, in conclusion, the smart money is short dollars. And when the dollar is short, usually gold is long, and that's good for gold. Our conclusion is effectively that nominal interest rates in these developed economies will decrease further, and we will continue to see an upward march in gold 3 or 6 months from now, and that this strength in the gold will continue. So we're quite optimistic about a bottoming in gold, and smart buyers and savers who will again pick up real physical gold at low or sale prices, on sale prices. In the past, the combination of negative real interest rates, massive quantitative easing or money printing, and large federal debt and federal government deficits has affected gold substantially, and it's always been positive for gold. We can't predict the future, but the past, in this case, has been kind to investors who value gold, and we foresee the same thing going forward. At Troy Gold, we're making it really simple, really safe, and really quick to save in real physical gold. So head over to our website at www.troygold.app to look at our physical gold account and gold-backed MasterCard. We hope you can join us. Thank you again for listening. Join the conversation and link up with us by joining our Telegram community. The link will be in the bio, or following us on Twitter. Our handle is @TroyGoldApp. Thank you again for listening. Keep stacking and keep saving in gold.